Welcome to the latest Motley Fool scoreboard. I'm on in Chockaballoo, and we've got longtime fools Jason Hall and Matt Frankle giving a 1 to 10 rating to Moneyball Rec and one of the buy now, pay later pioneers. Feels weird to say that. It's a pretty new industry. It's Klarna, ticker symbol KLAR. First, we'll rate the strength of Klarna's business, including factors like industry and competition. 10 is invincible. 1 is hopeless. Jason's at a 6. Matt, you're at a 7.
Yeah, Klarna has some key competitive advantages over other buy now, pay later companies, specifically that it's a bank. It has a large established market share in Europe where, buy now, pay later penetration's a little higher. It's definitely a competitive space. There are some strong competitors. Affirm, PayPal, Sezzle, SoFi. There are others that have buy now, pay later operations. Klarna's been an impressive company when it comes to innovation. One example, their new higher-end membership programs designed to essentially mimic what high-end credit cards give you, like airport lounge access. But it can potentially be replicated, so I don't know how much of a competitive advantage it'll be long-term.
Yeah, so admittedly, my 6 probably is a low score, but it's for some of the reasons you talked about. Those advantages, I don't think they're moats. There's nothing there that looks like can't be replicated. But what's good about Klarna, it's large but still growing. You talked about buy now, pay later as this new disruptive thing. I think it's more of like a repackaging of existing products. The difference now is that the companies that were behind the money in the past, providing the service to retailers, now they're the brands like Klarna, and it's a 20-year-old company. So it's really good at repackaging those things. The reason I'm a 6, though, is a lot of things that Matt talked about. It's hyper-competitive space. It's very cyclical. It's the riskiest sort of lending. And as a bank, customer deposits provide a lot of the funding, so there's a lot of leverage. And when that goes bad, it goes bad spectacularly.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Jason's at an 8. Matt, you're at a 9.
Yeah, Sebastian Shamiowski, he founded the business in his 20s. He's been at the helm ever since. He's done a great job of turning it into a leading company, a leading financial services company, not just a buy now, pay later company in Europe. He has a really ambitious vision for the business, essentially disrupting all of the financial system and branching out into other financial services. So I think he's done a great job so far, and I'm excited to see where it goes.
Yeah, I really struggle with this one, and I think even an 8, there's a reason to argue against it because we don't really have a public track record in terms of generating returns for investors because this is a business that's been around privately until just a couple of months ago. But when you're a bank and a lender in a high-risk area and you've lived for 20 years and you can tell the tale about it and go public with a multi-billion-dollar valuation, there has to be something there. We have a lot of financial data. Again, because it's a bank and it's borrowed public debt, it's issued financials for years, and that data does look really good. Definitely the driving force of the 3 founders and the only one that's been around really over the past decade. 7% of shares that he owns. One of the other founders actually owns more of the business. I think that says a lot about the quality of leadership, that a former founder that's been uninvolved for that long still owns more than even the current CEO. And we have that alignment that says a lot of good things about management, I think.
For financials, a 10 is a fortress, a 1 is yikes. Both of you have 7s, Matt.
Yeah, they have a great deposit base. They have about $2.6 billion in debt in addition to that deposit base, so that's worth noting. The company's not bottom line profitable, which is a bit of a red flag maybe at this stage of its evolution. But a lot of it's because they have higher loan loss reserve requirements as the business builds. I'd push back a little bit on what Jason said about buy now, pay later being a risky form of lending. Klarna's 0.41% loss ratio would make pretty much any other lender jealous. So I think that the financials, 7 might even be a little bit low other than, the fact that it's a very cyclical business.
Yeah, I'm going to push back on your pushback because all lending is safe when the economy is going well, and the economy is going well. This is the lending that is on the leading edge of risk when economic conditions deteriorate. So we're going to learn a lot more about Klarna as a new public company, rapidly expanding into the U.S., which is its best growth market, and how U.S. borrowers do in terms of repaying those loans. Again, I'm a 7 as well, so I think the business is on really good footing. The thing I do want to point out is that it didn't go public to raise a bunch of money to use to grow the business or pay off debt or anything like that. The balance sheet was good when it went public. It largely went public because it was a 20-year-old business that had a lot of insiders and large investors that wanted to be able to liquidate some of that investment and turn it into profit. So the balance sheet is strong. Even with the losses, I want to hit on one thing on the losses we just saw in the last quarter, Matt. a lot of that is more of a feature of its rapid growth than risk. Like you said, loan loss provisions are a thing, and they have to start taking loan loss provisions as part of bolstering the balance sheet as they take on more loans. So if you remove the couple $100 million in loan loss provisions that it took in its most recent quarter, even if you cut it down to what we saw year over year, it would have been profitable. So I'm not concerned about that. I think it's more of a feature of growth than any sign that there are worsening payment trends or anything like that. In the near term, everything looks good. And in the long term, I think the balance sheet's strong enough that it should be fine in any but maybe the worst case kind of economic conditions.
All right, Jason, let's talk valuation. How well will Klarna stock do over the next 5 years, and how safe is it? 10's a sure thing, 1's a lottery ticket.
Yeah, I think this is probably the area that Matt and I probably disagree on the most. My safety score is a 5. I think it's a moneymaker, and I think it outperforms, again, so long as economic conditions remain strong, but it's probably a little bit more binary than more bullish investors think. 5 years from now, the economy is good and it's been mostly healthy over this past 5 years. I think we're going to see it on the higher end of a 10 to 15% range. If things are not good in 5 years, or if the economy hasn't been great, it's probably going to be lower and maybe a lot lower.
Yeah, I think the cyclicality is more in terms of loan demand than loan risk, in my opinion. But I said the same 5-year return of 10 to 15%. I gave a safety score of 7. I think its status as a bank, plus that big European market share for things other than just buy now, pay later, gives it a little bit more safety than rivals. The U.S. business is growing very fast. The growth could slow down in a recession, but I don't think the loan portfolio is as risky as Jason does.
Thank you to both Jason and to Matt. They've given Klarna a surprisingly solid overall score of 7.1 out of 10. Matt doesn't have a top it, but he has an equal it in Sezzle. Meanwhile, Jason and I are on the same page when he says, if I'm investing in a financial stock today, it's not a BNPL company. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Qualcomm. Till then, full on.
These are very short-term loans. People link them to their bank account before they can even be approved. Their default rates are so low. They're just automatic payments. They have more flexibility. They're not sitting there with a big loan portfolio forever.